Hey everybody, welcome to the first ever Monday Mortgage Minute. The idea of this is basically every Monday, you're just going to create a little 60-second or as close to it as possible short on something out in the mortgage world, whether that is talking about escrows or whether it's talking about title policies or in this case, talking about interest rates. Either way, just want to create a little something that hopefully over time will create kind of a body of useful information for anybody who cares to take a look. So this will be on YouTube as well as my Facebook business page. And yeah, I hope you guys get something out of it. So basically today, just want to kind of highlight the idea of what an interest rate is as opposed to APR. We hear that term thrown around a lot, but very few people know really what it is or how to calculate it or, problems associated with basing your decision on a mortgage company off of strictly APR. So for starters, let's kind of go in and take a look at what an interest rate is as opposed to APR. So your interest rate, pretty self-explanatory, right? That's basically the cost that you pay in interest for your mortgage. APR stands for annual percentage rate, but really what it is an expression of both your mortgage interest rate plus any other finance charges associated with your loan, and that's all expressed as a rate. So to kind of show you how to calculate that, like if your interest rate on your mortgage is 5%, which you can see highlighted there, then and you've got an extra 2 grand of finance charges, okay, which that could be uh, an origination fee, it could be an underwriting fee, it could be prepaid interest, really anything that is associated with the financing of your loan, right? Then you can see that your APR is actually going to be higher than your interest rate. Okay, so how do we calculate that? Well, let's just say hypothetically that your amount borrowed is $100,000 just for simplicity. Okay, loan term 360 months. That's a standard 30-year mortgage. Okay, so if we calculate the payment on that, you can see it's 5% annually divided by 12 for your monthly rate, a total term of 360 months, and $100,000 that you're going to end up paying back, right? So we get a payment of 536.82 a month. Now, if we backwards work our way into this, okay, and we basically solve for the APR, then we can just kind of backwards work our way into this. Okay, so we're borrowing $100,000, but it's going to cost us 2 grand to get that. Okay, and so effectively we're only really getting $98,000, and so we can work backwards. Just a simple rate formula calculation in either Google Sheets or Excel will kind of get you there. And we can see that the APR is actually 5.18%. Okay, now if we increase the finance charges, so let's say our closing costs go up, right? Because there's a shyster lender out there that's charging you a bunch of money. Well, if we up that to 5 grand, then you're really only getting 95 grand financed, right? Effectively. And so your APR jumps. And that's the way that reflects in a loan estimate or closing disclosure or anything like that. So what's included in APR? Well, that's finance charges. That's origination fee, underwriting fee, processing fee, any sort of prepaid interest. So like if you close mid-month and you've got to get to the end of the month as far as interest costs are concerned, discount points, that's where you basically pay money to achieve a certain interest rate, and a couple other miscellaneous odds and ends. What's usually not included in APR is your title policy, appraisal, survey, any other inspections you might get. If your property has a septic system, you might want to get a septic inspection, or it might be something that's actually required in your loan. Who knows? So those items are typically not included in APR. Now, hopefully, I know that was a little bit more than a minute, but hopefully you got some good information out of it, and look forward to talking with you guys again soon. Thanks.